So we already know in high school they taught us nothing about financial literacy. And most of us go in our 20s not understanding any of the financial terms. And not understanding it costs you thousands and thousands of dollars and keeps you stuck and never growing and building wealth. So in this video, what I want to do is give you the 20 essential financial literacy terms that you certainly need to understand if you want to build wealth and get yourself out of the rut that you're in right now. Because if you don't know these terms, and don't feel embarrassed because I didn't know most of these terms, then you are never going to be able to build wealth. So I'm going to break it down in 4 categories. One of the categories is going to be the core depth or how money works. The next one is going to be on earning and budgeting smarter. The third one is going to be about your credit. And the fourth one is going to be about investment and growth mindset. The first term in understanding how money works is your net worth. You'd be surprised how many people do not understand what a net worth is. It's your total amount of assets minus your liabilities. That is your net worth. Most of us in our 20s, it's negative, and that's okay. But you need to understand exactly where you're starting from if you want to know where you're going. Now, don't get this all confused. So many people all over social media are bragging about how big the credit card limit is. The credit card limit has nothing to do at all with your net worth. All that does is just show your ability to borrow. So when it comes to assets, it could be your house, it could be your car, it could be anything that's valuable that you can sell and get money for. And when it comes to liabilities, it's anything that you owe. As simple as that. The second term I want to discuss about how money works is cash flow. Very simple. Money coming in and money coming out. That is your cash flow. What you want to do is always end up in the positive. So let's say you bring in $5,000 and $4,000 is going out with expenses. Well, then that $1,000 is a positive cash flow. But if you're making $5,000 a month and you're paying $6,000 in bills, well, then you have a negative cash flow. The whole key here, guys, is to try to get it as positive as possible. Most of us now are grinding, living paycheck to paycheck, going through so much financial turbulence that it's really hard to see a positive cash flow. But you certainly need to focus on that because having a positive cash flow will allow you to save and invest. And if it's negative, well, obviously you know what will happen. The third term with how money works is compound interest. They never taught us this in school whatsoever, but you might hear the term compound interest, especially when you're investing in the market. And for some people, they don't understand, especially when you see a calculation with how much money you can make if you're investing in the market due to compound interest. It doesn't make sense. But to make this as simple as possible, let's say you have $100 you invested and you made a 10% return. And now you have $110 you're investing. Now let's say you keep that money sitting in the account. The $110 now will get compounded with another 10%. So now you will have $121. That's the beautiful thing about the compound effect. It's small, but throughout time, it starts building and building and building. It's going to outpace the amount of time that you need to work to build that money. Compound interest is always going to get you to building wealth a lot faster than you working a 9-to-5. The fourth key term is inflation. Right now, you're hearing everyone talk about inflation, about how expensive everything is. And inflation is really important, especially when you're investing, because it erodes your purchasing power throughout time. Let's say right now it's 3% a year inflation, and you have your money sitting in a savings account in your bank earning 0.1%. Little by little, your money is being eaten alive. That's why it's really important to put your money in a high yield savings account. Put your money into the market, in an index fund, S&P 500, because you need to outpace your inflation. But if you continue leaving your money under the mattress, then eventually inflation is going to tear your money up. So the key with inflation is you just need to make sure your money is outpacing inflation. And the fifth term is opportunity cost. Everything you do in life is an opportunity cost. Let's say, for example, you have some debt and you decide to go on vacation with your friends. The opportunity cost is rather than paying off your debt, you're foregoing that in order to go on vacation. Every decision you make in your life, whether you want to get a car, whatever the case may be, there is an opportunity cost, meaning there's other things you could have done with your money. So it's really important. Anytime you make a purchase, you think, what can I actually do with my money? If you have bills, a lot of bills, and you're behind on your bills, well, you should put your money towards that to pay it off. It doesn't mean you don't get to enjoy life, but just understand you can't have too much enjoyment if you're living life with debt. And if you really master the opportunity cost, you become a whole lot wiser with your money. Okay, now let's talk about earning and budgeting smarter. The sixth term, and this is funny because it took me a while to learn this, which is gross and net income. When someone asks you about your gross income, All they're saying is they want to know how much you get paid before taxes. When it's net income, that's after taxes. So when you're doing your budget, you want to base it on your net income, the money you take home. I'm not gonna lie, in my 20s, when they asked you for net and gross, I always had to look it up. It's really crucial to understand the difference between both of them. And the seventh term is budget. Yeah, we all neglect a budget, but that's really simple, guys. That's writing down all your expenses and your monthly income with your monthly expenses and find out how much money you have left. If you wanna plan anything, any type of event, put it within your budget just to make sure you know exactly where your money is going and you will not have any surprises. And to be honest with you guys, I hated a budget, but I was broke. So I recognized if I didn't want to be broke anymore, I need to do a budget. I need to plan wisely and know exactly where my money is going. The eighth term is an emergency fund. Now, when it comes to emergency funds, I mean, it's self-explanatory. It's money put aside for emergencies. But it gets really complicated because people think an emergency fund is for going on vacation or spending on money on shopping. That's not an emergency. An emergency is truly something in your life like a flat tire or a health scare or a job loss. That is an emergency. And you want to save 3 to 6 months. 3 months if you have a stable job. 6 months if your job is a bit shaky. Now, what I highly recommend is do not put your money, because remember, we talk about inflation, do not put your money in a savings account within your checking account you have. It's too low. Put your money in a high yield savings account, or you could put it in a CD as well. But with this money, you do not want to put it in the market. There's too much turbulence happening in the market, and investing this money in the market could be extremely risky, especially if you have an emergency. But the main key here is you want to be able to gain access to this cash quickly, less than 24 hours, just in case you have an emergency and you don't want to dip into your credit card to make that payment and then pay it with cash. You don't want to do that. You want to avoid having credit card debt. The ninth term is discretionary income. This is money you have left after you paid all your bills. We all want to have a higher discretionary income, which means essentially FU money. Enough money we can just buy what we want, do what we want, and do not need to think about it. The higher discretionary income, the better you will be financially. The smaller amount that you have, the more financial stress that you have, and most likely you're having right now, and it's never going to get better until you increase that. And the 10th term is lifestyle creep. Anytime you get money, you just start spending and spending and spending all the way up to your limit. And that happens to so many people, especially when you get a job promotion and you buy yourself a house, then you get another job promotion, then you buy yourself a car. You keep on inflating your life based upon the income you're receiving. And lifestyle creep is the number one silent wealth killer. If you don't manage that, it will tear you up. Think about it. How much of us remember how much money we made in our 20s? Not a lot of us did. And how much assets did we get in our 20s? Not a lot of us did. Most of us got liabilities, but we had a hell of a life. We went on vacations. We did so many things, but we did not save and invest because we allowed lifestyle creep to dominate our lives. Okay, here's the next category. It's debt and credit management. Now, the 11th term is credit score. The higher the credit score, the better. You want to get something between an 800 or higher. You do not want to have anything that's 600 or below because your credit score indicates a few things actually. Number one, if you get the job. A lot of companies look at your credit to see if you're someone that's worth being hired. And also, we all know for a mortgage or car loan, any other credit cards, all of that, your credit score is highly critical. The better rate you will get, aka the lower rate you will get, the least amount of money you're paying interest, is predicated on your credit score. So by all means, protect your credit score as much as possible. Make sure you make your payments on time. Make sure you're not walking around with a whole bunch of debt. Keep your debt low, under 30%. That way your credit score will stay intact. The 12th term is interest rate, APR. This is the amount of money that you are paying on whether you get a car loan, credit card, mortgage. It's the APR. Do not get it confused with APY. APY, which is the average percent yield, is usually what you would see like in your savings account and your CDs. But the APR is the rate that you're getting charged on all those loans. So this ties in with your credit score. The lower credit score you have, the higher APR you have, which means you buying anything on credit will be a whole lot more expensive. The 13th term is secured and unsecured debt. If you have a secured debt, that means you put money up as collateral. If you have an unsecured debt, you have no money up for collateral. Usually people with good credit will have unsecured. People with bad credit or trying to rebuild their credit will have a secured debt. The 14th term is debt to income ratio. This is a ratio you will hear about a lot, especially when you're going to buy a house. They want to make sure the amount of money you bring it in compared to your debt is enough to make the payments on a mortgage. So let's say, for example, you make $5,000 a month and you're paying $1,500 in all these expenses and liabilities such as a car, credit card, school loan debt, all of that. That right there is a 30% debt to income ratio. That is pretty high, and you might not get approved because you will be a risk to paying back this new obligation that you're about to add on. So the key here is you want to keep your debt really, really low. The lower you are, the better credit score you will have, and also the higher approval for any type of mortgages. The 15 term is the minimum payment trap, which most of Americans are struggling with. A lot of Americans don't look at the total cost of things. They just calculate if they could afford it based on the minimum payment. That is a big trap because you're getting so much liabilities and you're trying to make these little payments that might have a high interest rate, or it might be stretched out for years and you're thinking you're doing good, but you're not, because it would take you a very, very long time to start paying off that debt. Especially, we see this the most with credit cards. Take a look at your credit card statement. It will show you how long it would take for you to pay off your credit card balance if you continue making a monthly payment. You will be surprised. Most of them is 6 to 7 years for a purchase that's as simple as $2,000 to $3,000. And what makes matters even worse is all you're doing is making these banks rich by continuously paying them all this interest. You do not want to be the person that's paying interest. You want to be the one that's investing and saving, gaining interest. Now, the next category is investing and growing wealth. The 16th term is asset allocation. When you start investing, which we all want to make sure you get to that point, you are going to hear terms about asset allocation. Someone might ask you, what's your asset allocation? All they're really asking is how much of your portfolio you have in stocks and in bonds and other types of currencies, like in this case, like cryptocurrency. But the reason why understanding what an asset allocation is extremely important, because it lets you know about your diversification in your portfolio. Let's say if you're someone that has, 50% in equities and 50% in bonds, that's showing you are extremely conservative, especially if it starts having more bonds than stocks. But if you're someone that has a high percent, let's say 90% in stock and 10% in bonds, that's letting everyone know that you are extremely aggressive and you are in the accumulation stage and the growth stage of your investing. The 17th term is risk tolerance. All this is saying is how much risk are you willing to take? Now, this is something that really depends upon in your age. If you're younger, yes, you can take on a lot of risk. And when I say risk, I don't mean like investing in crypto. I mean like having a portfolio following an S&P 500 index fund and just going with nothing but just stocks and no bonds, because you are able to ride the wave. So your risk tolerance in your 20s, is a lot higher because you have 15, 30, 40 years by the time you'll be able to retire. But if you're someone that's retiring really close, you're right now in your 50s and you're about to retire, that's when your risk tolerance starts going down because you want to be able to keep as much money as possible. The 18th term is an index fund. An index fund really is just a basket of funds that follows the market. The one you're going to hear about the most is S&P 500. So a company will create the same thing. They will mimic it. That way it follows exactly what the market is doing. In this case, the S&P 500. The best thing about this is it's extremely low cost. So when you hear everyone talking about index funds, that's the one you really want to look into and you want to invest in. So don't really get confused when you hear that term. It's simply just following the market. That's it. And the name of the fund is letting you know which market it's following. The 19th term is tax advantage accounts. A tax advantage account is your company 401k, a Roth IRA, and also a HSA, which is your health savings account. All of these are tax advantage accounts. If you're new with personal finance, you're going to hear so many people say take advantage of those accounts first before you start investing. And that's all it really is. It's saying get your company 401k match, open up a Roth IRA on your own with Fidelity and Vanguard and put money in there, and also put money in a health savings account. All this money when you're investing is not taxable. It's only taxed in your later years when you're not working as much, so your tax bracket shouldn't be that high. The main thing with it as well is your money grows tax-free. And the 20th term that you will hear is time horizon. If someone wants to know your risk tolerance, they're gonna ask something like, what is your time horizon? All that really means is how long is it going to be before you retire? Or how long is it going to be before you need that money? That question is extremely crucial. Back to what I was saying when it comes to asset allocation. They need to understand how much you want to have in equities and how much you want to have in bonds. That's a question you will hear a lot from financial advisors, or if you're just having a conversation with someone. So there you have it, guys. Those are the 20 financial terms that everyone should know that they never taught us in high school that is extremely critical for you to build wealth. If you have any other terms you want to add, drop a comment down below. In the same time, guys, hit the like, leave a comment, and subscribe. And go ahead and be confident and start investing. Have yourself a good one. Peace.